Ladies and gentlemen, get ready because suddenly and unexpectedly, in a move that has sent significant tremors from Wall Street to Wellington, India has just sold off a massive amount of its US government bond investments, and worldwide markets are clearly unsettled. Why did this occur? What does it mean for the world's financial framework? And could this be the instant that finally reveals just how fragile the global economic system really is? Stay tuned because this event is much more profound than anything the newspapers are reporting. Now imagine this: the world's fastest growing major economy abruptly decides it no longer wants to keep billions of dollars tied up in American debt. No warning, no polite notice, no carefully worded diplomatic statement. Just a swift, determined sell-off. The US dollar falters, bond yields shoot up. Traders start sweating in their expensive suits. And the question echoing across trading floors, government buildings, and international groups is very simple. Is this a smart strategic repositioning, or is it a financial warning sign loud enough for everyone to hear? This is not just a small tidying up of investments. This is a clear, strong statement that is impossible to ignore. When a major economic force steps back from the US Treasury market, it is not just shifting money around. It is questioning an entire system, a financial structure built up over many years. And let's be honest, the global power structure hates surprises like this. It highlights weaknesses they would rather pretend do not exist. It reminds the world that influence is changing and that change is not always favorable to Washington. When a country as economically important as India suddenly decreases its investment in US government debt, the results go far beyond a simple change in holdings. It disturbs a very sensitive and carefully balanced key part of international finance. US Treasury bonds are seen as the world's safest and most easily traded assets, relied upon by central banks, huge government investment funds, and large financial institutions to keep their reserves stable. If India suddenly sells a large part of its holdings, the immediate effect is pressure that pushes bond prices down and interest rates up, signaling clearly to markets that an important player is withdrawing from the traditional safe asset. Investors do not take such actions lightly. They see them as possible signs of decreasing confidence. Questions instantly arise about whether other countries might do the same, and the mere possibility of widespread selling is enough to increase uncertainty across global financial systems. When a major economy sells off a substantial amount of US Treasury bonds, one of the first and most obvious results is a spike in fear-driven guessing. These bonds are the foundation of global financial stability. So even the feeling of reduced trust rattles markets in ways that can be felt across the world. As selling pressure increases, bond prices naturally drop and yields begin to rise. Higher yields mean that borrowing money becomes more costly for the US government, and markets quickly start to wonder if this change reflects wider concerns about America's long-term government spending habits, political disagreements, or future economic prospects. Traders are extremely sensitive to these movements because Treasury yields affect everything from home loan rates to company borrowing costs to global money supply cycles. A perceived drop in confidence sets off a chain reaction. Currency markets react immediately. The US dollar can weaken as global investors rethink whether US debt is still the completely secure investment it has always been assumed to be. Stock markets usually follow with uncertain movements as investors become more cautious, reducing their willingness to take risks. Analysts rush into intense debates over whether the selling was purely a financial choice or a geopolitical message disguised as a money decision. And that uncertainty alone increases the feeling of instability that markets strongly dislike. Global investors hate uncertainty because it disrupts the normal flow of money. As doubt spreads, central banks and massive funds may reconsider their own positions, even if they do not act right away. Meanwhile, financial news outlets amplify the tension. A technical investment shift becomes a sensational story about power shifts, possible cracks in the global structure, or the slow rise of alternatives to the dollar's dominance. The effects spread far beyond the US. Developing nations might see sudden money outflows. Bond prices worldwide may change. Economic predictions are adjusted as institutions prepare for possible problems afterwards. In such a situation, fear quickly increases instability. Not because the selling alone changes the global economy, but because it forces the world to consider which other financial problems might follow. Whenever a country the size of India reduces its US bond holdings, the world eagerly tries to guess the reason behind the action, because decisions of this magnitude almost never happen without a global political context. One possible explanation is planned diversification. India might be trying to rebalance its reserves toward gold, other countries' bonds, or local investments that offer different risk levels and decrease reliance on the US financial structure. Diversification is a common strategy for countries wanting more control over long-term financial planning, especially during times of global uncertainty or when currency changes threaten the future value of reserves. Another interpretation is sending a political message. Financial decisions of this size can act as subtle diplomatic signals. A sell-off might show India's desire to act independently. In a world where strategic alliances are changing quickly and where economic influence is often used as a diplomatic tool, reducing exposure to US debt might be India's way of showing that it is not limited to one financial partner and plans to expand its connections across Asia, Europe, and the Middle East. Even without a clear political message, the timing alone can lead analysts to guess, especially during moments of diplomatic strain or negotiations. A third possibility is related to domestic economic needs. India may expect future needs for available cash, large infrastructure spending, or currency management, and selling US bonds provides immediate money without increasing taxes or internal borrowing. Economists also consider whether India expects US interest rates to rise. If yields are expected to go up, selling sooner can protect reserves from possible price drops. These different explanations lead to intense discussion because they represent different ideas of how India sees its role in a quickly changing global environment. The moment news spreads that India is reducing its US Treasury stake, global investors do not wait for official statements. They react immediately, emotionally, and often without full reason, setting off a wave of turbulence. Driven much more by fear than by solid facts. Markets are designed to react to signals from major economies. And when one of those signals suggests moving away from the world's safest debt investment, uncertainty spreads quickly. Traders begin changing their positions. Funds start making aggressive protective moves. Currency trading desks prepare for sharp changes. This widespread reaction makes India's move seem much bigger than its actual size, because the fear of a potential ripple effect, where other nations might follow, can be stronger than the event itself. In foreign exchange markets, this uncertainty shows up as rapid changes not just in the US dollar, but also in the currencies of developing nations that rely heavily on general global risk sentiment. A stronger or weaker dollar caused by guessing about the sell-off can affect commodity prices, trade balances, and inflation forecasts across many economies. Stock markets show increased unpredictable movements during the day as investors pull back from riskier investments, concerned that rising US yields or political tensions could slow global growth. Even bond markets outside the United States feel the effect as money managers reevaluate where they put their funds to avoid possible interest rate surprises. News coverage increases the chaos because sudden, unexpected financial moves make for attention-grabbing headlines. These headlines encourage more guessing, causing ordinary investors to worry about their savings, retirement funds, and currency exposure. This creates a cycle where fear causes instability, and instability causes even more fear. Central banks and major institutions often try to calm the situation with public statements. But until clearer facts emerge, the global investment world remains highly alert. Before I continue, I want you to do something simple. Share your thoughts in the comment section. Is this a planned step toward economic independence or a risky move with worldwide consequences? Your opinion helps move this discussion forward. Whenever a major economy sells a noticeable portion of US Treasury bonds, officials in Washington are forced to react fast. This is because trust in US debt is central to the global financial system. Even though the Treasury market is huge and usually stable, sudden moves by major foreign holders raise concerns about whether other countries might also reconsider their positions. This forces US leaders from the Treasury Department to the Federal Reserve to strongly promote stability, assure investors, and emphasize the strength of America's economic foundation. Their goal is to prevent the market from assuming that such a sell-off suggests deeper problems or political uncertainties that might weaken trust in the dollar. Leaders typically start by highlighting how easily the Treasury market can handle trades and how stable it is, emphasizing its ability to manage changes without harming long-term steadiness. Behind closed doors, they often reach out diplomatically to understand the reasons for the selling and to find out if more reductions are expected. Such conversations help avoid misunderstandings that could lead to bigger financial or political problems. Meanwhile, analysts within government offices closely track yield changes, currency movements, and money flow to determine whether intervention or stronger communication is necessary to keep feelings stable. The U.S. also relies heavily on communicating to domestic markets, reminding institutions that changes in foreign holdings are normal and that long-term demand remains strong from retirement funds, financial institutions, and global investors looking for safe investments. If yields jump suddenly, officials may describe it as a natural market adjustment rather than a sign of reduced confidence. This type of message helps manage fear and refocuses attention on the broader economic picture. In a world where perception can affect money more than actual performance, shaping the story becomes almost as important as stabilizing the markets themselves. India's decision to reduce its holdings of US Treasury bonds usually indicates a careful shift toward assets that better match its long-term economic goals, and such changes are rarely sudden. Nations diversify their reserve money to manage risk, protect purchasing power, and stabilize their currencies when global conditions are uncertain. For India, putting more reserves into gold is a logical step because gold acts as a protection against inflation, currency changes, and political pressure. When global markets appear unstable, or when faith in major reserve currencies declines, gold becomes more appealing, offering a security that is not tied to one country's financial decisions. When a country like India significantly reduces its exposure to US Treasury bonds, the global financial community begins to look not only at the immediate reaction, but also at the long-term consequences this choice could set in motion. One of the first concerns is how this decision may affect long-standing economic partnerships, especially those built on trust in the US dollar and its debt instruments. If an emerging power signals a willingness to reevaluate its reserve strategy, other developing economies may be encouraged to follow similar paths, slowly leading to a change in how global reserves are managed. Such transformations do not happen instantly, but they start changing expectations about how financial influence may be distributed in the decades ahead. Moves like this also highlight changing political power dynamics. Countries increasingly prefer financial strategies that reduce dependence on any single dominant economy, especially when global tensions or trade conflicts increase. India's action could be seen as part of a larger plan to assert financial independence and strengthen its identity as a balancing power in a world with multiple centers of influence. Over time, consistent diversification among powerful nations could slowly reduce the psychological and practical dominance the US dollar has held for generations, affecting how global trade is paid for, how international borrowing is priced, and how countries prepare for economic shocks. Another long-term result could be the quicker development of alternative financial systems, such as regional payment methods, new trade currency agreements, or increased reliance on international development banks that operate outside dollar-focused systems. Such changes can slowly decrease the influence of institutions long controlled by Western powers. At the same time, India's decision may pressure the US to review parts of its financial strategy, debt management, or diplomatic outreach to maintain confidence among its major foreign lenders. Even if markets quickly stabilize after the initial reaction, the deeper consequences remain because they involve trust, strategy, and the future shape of global finance. When news breaks that India has reduced its treasury holdings, public discussion starts almost immediately because the action raises deep concerns about global power balance, economic safety, and national strategy. Critics argue that such a reduction introduces instability into already stressed markets and risks creating diplomatic problems. They question whether the timing is right, especially during periods marked by high inflation, political pressures, or difficult supply chains. Some fear that becoming less reliant on US debt might expose India to new financial risks if altered. Additive assets fail to provide the reliability that Treasury bonds have long offered. Supporters, however, view the move as a powerful statement of economic self-reliance. They believe that for a country with India's growing global importance, depending heavily on US assets is old-fashioned and potentially limiting. From this viewpoint, shifting reserves is not a reckless disruption, but a strategic adjustment that fits the new global arrangement. Advocates point out that diversification is a normal practice for nations seeking long-term stability, and that India's strengthening domestic economy offers new investment opportunities. They see the decision as proof that global finance is slowly becoming more balanced and less centered on one dominant power. This debate goes beyond analysts and politicians. Ordinary people, businesses, and political voices join in, viewing the decision through their own personal concerns and hopes. Some see new opportunities, others feel new uncertainty, and both sides push their opinions across social media and public discussions. What emerges is a widespread, often emotionally charged debate shaped not only by financial reasoning, but by national pride, global ambition, and the natural human tendency to react strongly when long-standing systems appear to be changing suddenly. Ultimately, what India has done is more than just a financial change. It is an event that forces the world to rethink its assumptions. A single action in the bond market has revealed just how interconnected, fragile, and politically sensitive the global economic structure truly is. Whether seen as strategic genius, brave, independence, or a risky gamble, one thing is clear. It has reminded every powerful nation that the landscape of economic power is changing. The time of unquestioned dominance, predictable partnerships, and automatic trust is slowly ending. And as nations reassess their priorities, the world enters a new era, one where every move matters, every signal echoes across borders, and no country can afford to ignore the evolving pace of global change.